is actually in reality in play, but we're not going to know until we try and revert back to some sort of normality. This is one of the key reasons why the central banks simply cannot allow rates to go up, because you will destroy any chance of recovery. So anything, if the market wants to go there and try and price in higher rates, yield curve control is going to kick in. We've got pseudo yield curve control in Europe, and we've got yield curve control in Australia, we've got it in Japan, and I think it would come in the US. And that means that rates can't actually price inflation. Now, I'm not an inflationist. I think we will get cyclical inflation because of the supply constraints and the massive rise of people coming back into the labor force and back in economic life. But as we settle down, I think the debt, deflation, narrative, technology, globalization, aging population, all of this stuff continues to weigh on inflation. And over time, as the economy settles to trend rate of growth, potentially inflation falls. I actually think trend rate of growth might change positively, and I'll come on to that at the very end of this, but it's not really a piece for this, and that all comes later. But it's the macro backdrop of that is very important to understand, because within this, the only answer was the creation of more money. And that creation of more money was clearly going to be very, very beneficial to Bitcoin, because it was basically created for this. And I pointed out early on, back in March and April, that Bitcoin was two things. It was this store of value narrative. And it also had a call option on the future. And I started developing some big meta-narratives to help get people across the line, because I know it's a scary, different world and people didn't want to understand this weird digital money. I don't want to throw money at this. But I tried to explain to people in simple terms things like pristine collateral, how this is superior than many things that we have in the existing system, or in fact, all of the things that we have, how it acts differently, how you can't create more of it, so as collateral it's worth more, and therefore is a better foundation stone for the financial system of the future, and how as a store of value, it offsets the monetary printing, and how this could all transition into a future economic system that had incredible value. And that's what made me irresponsibly long. And that, I think, helped a lot of people get across the line. The next part of it that I think was maybe the light bulb moment for many was my New Bretton Woods, the Bitcoin life raft piece. And that essentially was saying that, okay, what also is coming is the central banks have seen this digitalization of money and they want to be involved. And they want to be involved by creating central bank digital currency, not as a competitor to Bitcoin, but as an ancillary agent within this new digital money system. And that's all well and good. That's basically government stablecoins. Fine, I get it. It's much better. It works really well. But it also has other qualities, because the other qualities it's programmable. So essentially, central banks can program money so we all have different monetary policy or different tax regimes or whatever it may be. The point being is behavioral economics is going to shoehorn its way in to monetary and fiscal policy, which are combining. And at that point, we are really beholden to what central banks do. Can they destroy money? Can they destroy our capital, our savings? Of course they can. And we needed a life raft. And Bitcoin was going to be it. Now, as we wind forward, we're now seeing pretty much every government on earth running record deficits. This means that theoretically they're all bankrupt. But we know in this modern world of printing of money, bankruptcy in governments doesn't mean the same thing unless you can't print money. Hence why emerging markets get bankrupt, developed markets don't. So the answers to these record deficits is all the story of debt, really, right? How do you finance that debt? Well, you finance it in the age-old way: taxation, inflation, and debasement. So taxation around the world is going up everywhere, without question. And there's very little things you can do about that because legalities, whether you like it or not. But inflation and debasement, they're two different things. Now, central banks around the world have put inflation targets that are higher than where we are now. Will they be able to meet those? My view remains, and has been for the last 20 years, or maybe even 30 years, no. I don't think inflation is structurally able to be generated. I could be wrong. Of course I could. Let's wait and see the massive amounts of fiscal stimulus that has to come. Because these deficits aren't going away. There's another round of huge stimulus to come this year in the US alone, let alone Europe. Now, Europe is obviously slowing down with the virus again. There is more stimulus to come. And there's more stimulus almost everywhere. And so I don't think maybe that infrastructure spend generates inflation. Maybe it's just cyclical. Maybe it's structural. Maybe everything changes. I do not see how you get around the rise of technology, the aging population, globalization, and the dynamics of debt. I don't know how you generate inflation in that. So let's assume that doesn't happen. It's cyclical, spooks the bond market, the Fed do yield curve control and expand their balance sheet again when that happens. So that's an interesting thing. But monetary debasement is the thing that I thought about. And I think people confuse inflation, CPI, and debasement. You see, most people are looking for the dollar to collapse, not really thinking through the fact that everybody else is also printing money. And it seems to be, sure, the dollar might go lower when they're doing more than the Europeans, but overall, if you look with honesty at the DXY, something that I was expecting to see break higher, i.e. the dollar higher over last year, and it didn't. But when I look at the chart, it didn't break lower either, because everybody thought that. It kind of looks like it's range bound at about 96 as the average. So therefore currencies don't move. But that's interesting. That got me thinking. And rates can't really move either, because if they go up, then yield curve control comes in. If they go down, they're going to try and stimulate more. So then rates kind of drift higher a bit. So let's say US 10-year rates are maybe range bound between 0 and 2%. Maybe they go negative, maybe not. But either way, there's no rates trade to be had. The death of macro in rates, I think, is writ large. And I know many people think, no, you can short rates forever. Inflation's coming back. Yeah, but the central bank are not going to do that. And we've seen that in Japan. So what's very interesting is that as yield curve control comes in, it means that they buy bonds, and the central bank buy bonds by printing money. So I looked at that, and I looked at, okay, if there's no inflation, then where is this monetary printing going? And the argument had been for a long time that I didn't agree with, that QE found its way into financial markets. And I thought, I don't see that mechanism per se. Of course, it finds its way in some places. Wealthier people, corporates with better balance sheets find it easier to borrow. You see it, in the credit markets, how easy they are, that kind of thing. I get that. But the equity market was the one that didn't really pass the smell test, because the equity market rose on the back of QE, but volumes didn't. So then what's the buying? Where is the buying? What's going on? And at that point, I started looking at the chart of Bitcoin versus other assets. And many of you will have seen this in Macro Insiders and also on Twitter. And so what became clear, and this was we're now talking about September, October last year, that Bitcoin had already and was about to outperform every single asset on Earth. So all of the charts of, let's say, Bitcoin versus the S&P, Bitcoin versus the NASDAQ, Bitcoin versus gold, Bitcoin versus real estate, Bitcoin versus anything I could find, any asset. Sure, you can all find a single stock that's done better, but an asset class. Not one asset class on Earth looked like it was going to outperform Bitcoin. I'd never seen anything like that in my entire career. That made me pay attention. And then I put it against the Fed balance sheet. First, I looked at the S&P versus the Fed balance sheet. because the Fed balance sheet is the purest expression of monetary printing. I also use the G4 central bank balance sheets to look at the global printing of money. But let's use the S&P versus the Fed balance sheet. You can see the chart here. The market basically fell in 2008 80% and traded sideways ever since in this chart. What's interesting is gold looks similar. So if you look at the chart of gold divided by the central bank balance sheet, it looks similar. And if I look at the chart of real estate versus the central bank balance sheet, it too looks similar. But if I look at the chart of gold, which is the oldest denominator, the form of money, against the S&P doesn't look particularly expensive. A little bit expensive, but not the bubble that we're seeing. And that got me thinking about these relative asset prices and the fact that Bitcoin was outperforming everything. And I realized that I think we're all looking at this wrong, and I certainly had been. What that chart shows, or those charts, is that the denominator, which is not the US dollar per se, but the value of fiat currency in terms of what assets it could buy, because these are all fixed assets essentially, or low supply assets. Anything that was a low supply asset was going up in price, but it was going up in price in dollar terms. But when you look in money printing terms, they were basically holding their own after the massive collapse of 2008. And that intuitively feels right to us. You know, the anger and the frustration and the economic misery that's happened since is a function of that. And that makes sense. Variable inputs, like consumer goods and wages, were destroyed by this. And that makes sense too. So with